Angel tax is a term used for a tax imposed on unlisted companies in India. It applies when they issue shares to investors at a price higher than their fair market value. The excess amount is considered as income and taxed accordingly. This rule is described in Section 56(2) (vib) of the Income Tax Act, 1961. Angel tax was introduced in 2012 to prevent money laundering and round-tripping of funds through investments in unlisted companies with a large premium. However, it also affects startups and investors who raise funds from angel investors, venture capitalists, or other sources. Angel tax can have a negative impact on startups and investors in India in several ways. Some of them are: it discourages angel investors from investing in startups, as they have to pay tax on the valuation difference, which reduces their returns. It creates uncertainty and complexity for startups, as they have to justify their valuation to the tax authorities, which may not be easy or consistent. It reduces the availability of funds for startups, as they may have to share a part of their capital with the tax department, which affects their growth and expansion. It affects the competitiveness of Indian startups, as they may lose out to foreign startups who do not face such tax issues. To address these issues, the Indian government has proposed some changes to the angel tax rules, and some of them are: exempting certain categories of foreign investors from angel tax, such as central banks, sovereign wealth funds, government-controlled entities, foreign portfolio investors, endowment and pension funds, banks and insurance companies, and pooled investment vehicles. Expanding the valuation methods that can be used to determine the fair market value of unlisted shares, such as book value, net asset value, discounted cash flow, enterprise value multiple, price earnings multiple, net present value of future cash flows, etc. Allowing a reference price based on investments by venture capital funds or other notified entities for both resident and non-resident investors. Providing a safe harbor of 10% variation in value to account for forex fluctuations, bidding processes, and other economic indicators that may affect the valuation of unlisted shares during multiple rounds of investment. Accepting a valuation report by a merchant banker dated not more than 90 days prior to the date of issuance of shares as evidence of value. These changes are expected to provide more flexibility and clarity to investors and startups, and reduce the burden of angel tax in India. Angel tax is a term used to describe the tax imposed on investments made by external investors in unlisted companies in India. The tax is levied when the share price of the issued shares is higher than the fair market value of the company. The excess amount is considered as income and taxed accordingly under Section 56(2) (vib) of the Income Tax Act, 1961. The angel tax was introduced in 2012 to prevent money laundering and round-tripping of funds through investments with a large premium into unlisted companies. However, the tax also affected genuine investors and startups who often raise funds at a high valuation based on their potential and innovation. To address this issue, the government has proposed some changes to the valuation rules under angel tax that would provide more flexibility and certainty to investors. These changes are as follows. The government has expanded the valuation methods that can be used to determine the fair market value of unlisted shares. Apart from the discounted cash flow (DCF) and net asset value (NAV) methods, 5 more methods are available for non-resident investors. These are: book value method, market price method, net worth method, earnings method, and asset-based method. The government has also allowed the price of shares corresponding to investments by certain notified non-resident entities, such as central banks, sovereign wealth funds, government-controlled entities, etc., to be taken as the fair market value of shares for both resident and non-resident investors. The government has provided a safe harbor of 10% variation in value of shares to account for foreign exchange fluctuations, bidding processes, and variations in other economic indicators that may affect the valuation of unquoted equity shares during multiple rounds of investment. The government has also exempted certain categories of foreign investors from the angel tax provisions, such as Category I foreign portfolio investors, endowment and pension funds, banks and insurance companies incorporated in India, and pooled investment vehicles with over 50 investors. These proposed changes are expected to benefit both investors and startups by reducing the compliance burden, providing more options for valuation, allowing parity in investments by different types of investors, and accounting for market dynamics and uncertainties. The changes are also likely to boost foreign investment in India's unlisted sector, especially in startups that have high growth potential and innovation. India has the third largest startup ecosystem in the world, with over 50,000 startups and 105 unicorns. India's goal to become a $5 trillion market by 2024 is largely dependent on the significant economic contributions of startups. A combination of factors, such as a large market, a fast-growing economy, government support, and a diverse and innovative startup culture, has contributed to this success. But what are the benefits and challenges of attracting foreign investment in India's startup ecosystem? One of the main benefits of foreign investment is that it provides capital and resources to startups that need them to grow and scale. Foreign investors can also bring expertise, mentorship, networks, and access to global markets that can help startups expand their reach and impact. Foreign investment can also create positive spillovers for the local economy, such as job creation, skill development, technology transfer, and innovation. According to global data, a total of 1,726 venture capital funding deals worth $20.9 billion were announced in India in 2022 compared to 1,715 deals worth $33.8 billion, and some of the prominent foreign investors in Indian startups include Tiger Global Management, TGM, DST Global, SoftBank, Sequoia Capital, and Excel Partners. These investors have backed some of the most successful startups in India, such as Flipkart, Ola, Paytm, Zomato, Byju's, and Udin. However, attracting foreign investment also comes with some challenges and risks for India's startup ecosystem. One of the challenges is that foreign investors may have different expectations and interests than local entrepreneurs and stakeholders. For instance, foreign investors may prioritize short-term returns over long-term sustainability or social impact. They may also impose conditions or influence decisions that may not align with the vision or values of the founders or the local context. Another challenge is that foreign investment may create dependency or crowding out effects for domestic investors and entrepreneurs. For instance, foreign investors may dominate the market and reduce the opportunities or incentives for local investors to participate or compete. They may also drive up the valuation or demand for startups, making them less affordable or accessible for local entrepreneurs. Moreover, foreign investment may expose startups to external shocks or uncertainties, such as currency fluctuations, geopolitical tensions, or regulatory changes. Therefore, attracting foreign investment in India's startup ecosystem requires a balanced and strategic approach that can maximize the benefits and minimize the challenges. The government plays a key role in creating an enabling environment for foreign investment through its flagship Startup India initiative, which provides various incentives and support for startups and investors. The government also needs to ensure that foreign investment is aligned with India's national interests and priorities, and does not compromise its sovereignty or security. The startup ecosystem also needs to foster collaboration and synergy among different actors and stakeholders, such as entrepreneurs, investors, incubators, accelerators, universities, corporates, and civil society. The startup ecosystem also needs to promote diversity and inclusion among its participants and beneficiaries to ensure that foreign investment benefits all segments of society and does not create inequalities or disparities. In conclusion, foreign investment can be a powerful catalyst for India's startup ecosystem if it is leveraged wisely and responsibly. Foreign investment can provide capital and resources to startups that need them to grow and scale. It can also bring expertise, mentorship, networks, and access to global markets that can help startups expand their reach and impact. However, foreign investment also comes with some challenges and risks that need to be addressed carefully. The government, and the startup ecosystem need to work together to create an enabling environment for foreign investment that can maximize its benefits and minimize its challenges.